The silver market just flipped from boring to dangerous again, and that's exactly when most people make the worst decisions. Price has already moved fast. The crowd is screaming bigger numbers, and the next shock won't be the direction. It'll be the volatility on the way there. I'm John A.G., and you're watching our channel. Now listen closely, because if you're holding silver, the real question is not how high can it go. The real question is, will you still be holding it when it tries to throw you off the ride? We need to get one thing straight right up front. Silver can absolutely run much higher from here. Triple digits, not crazy. 200, possible. More, also possible. But none of that matters if we don't control our exits, our sizing, and our emotions. Because silver doesn't hand you profits politely. Silver slams you, shakes you, and dares you to quit. And here's the mistake most people make. They treat silver like a smooth investment, like a savings account with sparkle. It isn't. Silver is a leveraged bet on stress in the monetary system, and stress never moves in a straight line. So let's pause here. If your plan is, I'll just sell when it feels high, you don't have a plan. You have a future panic moment scheduled, and you don't know the date yet. What we want is a framework that survives the chaos. Fact, silver is volatile. Interpretation, volatility isn't random. It's the tool that transfers metal from impatient hands to disciplined hands. Now watch this. The loudest predictions you hear, silver to 500, silver to 600 next month. They're not analysis. They're adrenaline. And adrenaline is great for clicks, but it's terrible for your portfolio. We're not gambling. We're measuring. So what do we measure? We don't just stare at the dollar price and get hypnotized, because fiat pricing is like measuring your weight on a broken scale. It changes, but it doesn't tell the truth. The truth lives in relationships, spreads, compressions, and ratios. That's why the gold-silver ratio matters so much. If gold is the heavyweight champion, silver is the fighter who swings wild. When the ratio compresses, it means silver is outperforming gold. That's usually when silver looks unstoppable. And that's also when traps get set. Here's the uncomfortable part. Most people don't lose money in silver because silver failed. They lose because silver succeeds violently, then punishes their nervous system, and they sell at the wrong moment, either too early out of fear or too late out of greed. So we need a decision line that isn't emotional. We pick a ratio, we pick a range, we pick a profit threshold, and we respect it. Not because we can time the top, because nobody times the top. If you've ever tried to trade metals, you already know this. The market loves to make you feel brilliant, right before it humiliates you. Now, does that mean silver can't keep going? No, it means the path matters more than the destination. Silver is the kind of asset that can be up huge and still make you feel like you're losing, because it'll run 20%, then drop 15% in a week, then rip again, then smash down on a margin hike headline, then recover like nothing happened. And if you're not built for that, you'll hand your position to someone who is. Let's talk about that engineered pressure, because it's real. In markets like this, we often see the same playbook: liquidity squeezes, sudden rule changes, margin increases, and sell-only rumors that spread like fire. Whether every move is coordinated or not, the effect is the same. It creates forced selling. It flushes weak hands. It convinces you that your conviction was a mistake. And then the trend resumes without you. That is why the biggest risk in silver is not the price. It's the way investors are trained to react. We've been trained to measure everything in dollars. So when silver drops $10, it feels like failure. But if gold drops 2 and the ratio stays steady, what actually changed? Maybe nothing. Maybe it was just noise. Here's a clean way to think about it. Dollar price is the headline. Ratios are the story. And the story is what we trade, or what we hold, based on our strategy. Now let's separate two mindsets, because mixing them is how people blow up. If you're a trader, you need precision, tight risk management, and you need to accept you'll be wrong often. Traders can win, but they get paid for discipline, not opinions. If you're a long-term holder, you're not trying to win every week. You're trying to preserve purchasing power over years. That's a completely different game. And if you're long-term, the question becomes, what is silver's role compared to gold? Gold is the anchor. Silver is the amplifier. Gold tends to move like a slow tide. Silver moves like a storm surge. If you size silver like it's gold, silver will punish you. If you size it like a storm surge, silver can reward you without breaking you. So let's get specific. Free cash flow, that's a business metric. In metals, our equivalent is real value. Real value is what you can buy with the metal: land, energy, food, useful stuff. And that's why ratio thinking is powerful. Because if silver rises in dollars but rises less than gold, did silver really lead? Not as much as you think. If silver rises and the ratio compresses, that's when silver is doing what silver does in a true bull phase. Now the crowd is going to ask the same thing every time. Okay, but what's the price target? And here's our answer. Targets are optional. Process is mandatory. Because the moment you marry a number, 150, 200, 300, you start defending it like an identity, and the market loves attacking identities. So instead, we build a ladder. We decide what enough looks like for us, not for social media, not for some thumbnail, for us. Maybe we take partial profits when the ratio hits a level we believe is stretched. Maybe we rotate some of that into gold. Maybe we keep a core position we never touch. That's not boring. That's how you stay in the game long enough to win. Now watch the psychology shift here. Silver doesn't top when excitement peaks. Silver tops when confidence feels safest, when everyone stops talking about risk, when people start saying manipulation is over, or it can't drop anymore. That's when the trap door opens. So if you're hearing no risk narratives, we should get more careful, not more aggressive. And yes, manipulation talk is a distraction sometimes, but rule changes, and leverage mechanics are not a conspiracy theory. They're just market plumbing. And if you ignore plumbing, you'll be shocked when the bathroom floods. Here's the best practical approach for most of us. We accumulate in a way that doesn't require perfect timing. We dollar cost average. We scale in. We avoid going all in at one price. And we keep cash for volatility. Because volatility isn't a bug, it's the test. Now, quick side note, because some of you ask this every week. This is educational. We manage risk. Okay, now let's zoom out, because silver is not moving in a vacuum. Silver is attached to two giant forces at the same time. It's a monetary metal when trust in paper weakens, and it's an industrial metal when manufacturing demand rises. That combination is why silver can go quiet for years and then explode, but it also means silver can get whiplashed. If industrial activity slows, silver can dip even while gold holds up. If monetary fear spikes, silver can rip even before industry catches up. So we have to watch both forces without getting emotionally kidnapped by either. Here's the contradiction that confuses people. Gold can be rising because people are scared. Silver can be falling because factories are cautious. Both can be true. So the question for us is, what is the market paying for right now? Growth or safety? And if we're wrong, where will it show first? Now, let's talk about central banks and retail behavior without hype. Fact, big institutions have been increasing their interest in gold over time. Interpretation, that's a vote against holding everything in paper. Even if you don't like the politics, that doesn't matter. We're not here to argue flags. We're here to track incentives. Central banks don't buy gold because it's trendy. They buy gold because it settles without permission. And when gold becomes a more accepted reserve asset, it changes psychology. It turns gold from pet rock to strategic insurance. That shift matters, because when gold gets re-rated, silver tends to follow with leverage. That's why we see these phases where gold leads, then silver catches up like it was shot out of a cannon. But again, the cannon recoil is real. So if you're holding silver, we have to assume there will be shakeouts. Not maybe. There will be. The market will manufacture fear. Headlines will scream. Influencers will flip sides. And at the exact worst moment, you'll feel the urge to do something dramatic. That's the moment we don't flinch. Because the people who win this game are not the smartest. They're the calmest. Now, I want you to think about something personal. At what point is profit good enough for you? Not maximum? Good enough. Because maximum is how people round trip gains back to zero. Good enough is how people build wealth. So pick your line. And here's the second question. If silver rips and then drops hard, will you treat that drop as information or as an insult? Drop your answer in the comments, because your mindset will decide your outcome more than any chart. Now, there's another trap, waiting for the perfect pullback. This is where people sound smart and end up paying more. They say, I'll buy after a 30% correction. Okay, from what price? If silver goes higher first, a 30% correction can still leave you above today's levels. So you waited, you did nothing, and you still bought higher, just with more fear in your body. That's why we prefer accumulation over prediction. We don't need perfect entries, we need survivable entries. And survival means you can hold through the drawdown without selling your future. Now, let's address the elephant in the room. A lot of people feel like they missed the boat. Gold feels expensive, silver feels wild, and cash feels safe. But cash is only safe if purchasing power is stable. If purchasing power is melting, cash is a chair on the Titanic. It feels stable right until the water reaches your knees. So what do? We keep cash for flexibility, but we don't worship cash. We convert some of it into hard assets, slowly, consistently, with a plan. And for many people, that starts small. Grams, fractional, half ounces, whatever is manageable. Because the point is not to impress anyone. The point is to protect your future self. Now here's a creative twist, and we only say this because it helps the community. If you want silver-related success stories, real people, real moves, real lessons, there's a link in the description to another channel. Go subscribe there too, and see how different strategies played out in the real world. Back to us. So, what's the framework? We treat gold as the long-term core. We treat silver as the volatility satellite. We set allocation sizes that let us sleep. We decide ratio-based profit levels. We keep dry powder for shakeouts. And we refuse to let a headline steal our plan. Now, let's talk about what could go wrong. Because pretending there's no risk is how people get blindsided. One risk could be a sudden liquidity event that forces selling across markets. Another risk could be policy shocks that create short-term dollar strength, which can pressure metals temporarily. Possible risk: industrial slowdown hits silver harder than gold. These are not reasons to panic. They're reasons to size correctly. Now here's the part that most people won't tell you, because it doesn't sell dopamine. You don't need to catch the top to win. You need to avoid getting shaken out before the real move. That is the entire game. And it's why volatility is the toll you pay to reach the outcome. Now, let's talk about exits again, because exits are where money becomes real. If you're holding silver, decide whether your exit is dollar-based or ratio-based. Dollar-based exits are simple but fragile. Ratio-based exits require thinking, but they're grounded. If the ratio compresses dramatically, that's silver telling us it's sprinting ahead of gold. That's often where partial profit-taking makes sense. Not because silver is done, but because silver is temporarily overheated relative to its anchor. Then, we can rotate some gains into gold or into other hard assets. That's how you turn a volatile ride into a stable outcome. Now, we need to address a myth. People say, silver will hit a number and then I'll sell everything. That sounds clean. In reality, that's a recipe for regret. Because if you're right, you'll want to hold longer. And if you're wrong, you'll freeze. So we prefer staged decisions. Small sells, small buys, always with room to breathe. Now, if you're thinking, okay, John, but what about the bigger picture? Here it is. Fact: global debt keeps climbing. Interpretation: debt pressure makes currency management more aggressive over time. When governments have to roll huge obligations, they have incentives to keep the game going. They don't choose pain, they choose delay. And delay often looks like currency dilution. That's why hard assets matter. Not as a get-rich-quick scheme, as a get-poor-slow scheme avoidance. And yes, it can feel scary, because this isn't like buying a stock with a product story. This is buying a hedge against a system story, and system stories are heavier. Now watch the open loop. If silver is the amplifier and the system keeps deteriorating, then the question isn't just how high. The question is how many people will realize it at the same time. Because when everyone rushes through the same narrow door, price doesn't move politely. It gaps, it spikes, it creates shortages, and then the rules change. That's why we prepare now, not later. Now, I'm going to say something that might annoy traders. Most people aren't built to trade silver, and that's fine. Trading is a profession. If you're not doing it full-time with rules, tools, and risk limits, trading becomes gambling with a suit on. Long-term holding is not weakness, it's strategy. But long-term holding only works if you respect volatility. So don't oversize, don't leverage, don't chase, and don't let a prediction replace a plan. Now, comment this for me. Are you using a ratio to plan your silver exit, or are you still thinking in pure dollar targets? I want to see where our community is because that tells us how prepared we really are. Here's a signal we should keep on our radar: the difference between paper silver and real silver. Paper silver is contracts, promises, and leveraged exposure. It trades big, and it can get pushed around with headlines. Real silver is the metal you can take delivery of. It moves slower, but when real demand tightens, paper games get harder to sustain. So when you see a sharp drop that makes no sense, ask one question: did physical suddenly get easier to find? Or did paper just get louder? That question keeps you grounded. And yes, there are tricks that can hit the market overnight. Margin requirements can jump, liquidity can vanish, a sell-only rule can appear. None of that changes the long-term math, but it can change your emotions in 5 minutes. So we plan for it now. We keep our position size small enough that a dip doesn't force us out. We keep our conviction tied to signals, not feelings. And we keep a checklist. If silver is up, but the ratio isn't compressing, we don't get drunk on hype. If silver is down, but the ratio is stable, we don't assume the story is broken. If silver is down and the ratio widens hard, we get curious because that's where the next opportunity hides. Now tell me this in the comments. If silver dropped 20% this month, would you buy more, hold, or panic sell? Now, we're almost at the part nobody expects. Because the scariest moment in a bull market is not the crash. It's the fake calm. It's the phase where silver drifts sideways after a big move and everyone gets bored, and then, bam, the market launches again while you were distracted, or it slams down while you were overconfident. So we stay alert. We keep our framework. And we remember that this isn't about winning an argument, it's about winning our future. If you're getting value from this, hit subscribe right now. One click, that's it. And you'll stay plugged into the signals we're watching without the hype. Because the next time silver spikes, you're going to hear wild numbers again. And the real advantage won't be predicting the peak. It'll be knowing what the crowd will do before they do it. And the next move is going to test that, not in months, sooner than most people think.